Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Hadiza Jattao, VP and Portfolio Manager at Mackenzie Investments, will be joining us for the hour. Then in 30 minutes, we'll be joined by Brendan Bernard, Senior Economist at Indeed, to help break down Canadian labor data. And of course, we want to hear from you this morning on First Call. Reach out with your questions and we'll have Hadiza answer as many of the questions as you can at the end of the show. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. Our email address, firstcall@bellmedia.ca. Now, some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump says Iran is doing a, quote, very poor job of handling the Strait of Hormuz, saying it does not follow the agreement in place. Iranian lawmakers claim some ships going through the strait are being charged fees as high as $2 million. The comments come after this week's ceasefire talks between the two countries, with another round of discussions scheduled for Saturday. Revenue in the latest quarter at Chorus Entertainment came in below estimates. The Toronto-based media company reported a 15% drop in consolidated revenue, with its television business the biggest drag. However, Chorus did see its overall loss narrow from a year ago, with the CEO saying the company is making meaningful progress on key initiatives despite ongoing industry and macroeconomic pressures. The owner of Cold Stone Creamery and Mr. Sub posting higher first quarter profits despite missing revenue estimates. MTY Food Group reported net income of nearly $37 million, up sharply from a year ago. The jump was largely driven by foreign exchange gains. However, the company did miss revenue expectations as it saw a decline in corporate store sales in the United States. And now our top line story. It has been an interesting week, we'll say, for investors. A fragile Middle East ceasefire is sort of holding, ongoing fighting, uncertainty around oil flows through the Strait of Hormuz. The markets have been on edge. So what are the key risks investors should be watching for right now, and how is this shaping sentiment across global markets? Let's bring in our guest for the hour, Hadiza Jattao, and she is the VP and Portfolio Manager at Mackenzie Investments. Hadiza, thank you as always for joining us.
Thanks for having me.
What were we on, about a month ago? Were you here a month ago?
Yeah. That.
So not much has changed.
A lot happened. Yeah.
Holy cow. How are you looking at everything that's unfolding over this past week and over the past month, and what are you looking forward to?
Very good question. So we are now about 6 weeks into the conflict. Market has been somewhat reacting, not too negatively to the headlines, and we're getting to this point where we're past kind of the peak kind of narrative in terms of, yes, negotiations are happening, there's some form of ceasefire. I think this weekend is going to be absolutely crucial in terms of the directionality. I think on both ends, Iran on one hand doesn't necessarily want to let go of Hormuz. We've heard about the tolls that are being put on oil tankers. But the picture here leads me to believe that we need now to worry more about inflation. The conflict is one thing. Resolution of the conflict is one thing, but what does that mean? What does that mean for the global economy? And what that leads me to believe when I look at Hormuz, which is 20% of oil supply, it's about also 1/5 or LNG supply coming from Qatar predominantly. That leads to higher inflation, because if you know 50% of oil that is used is not used for transportation. It's used for production of aluminum, fertilizer, for instance, in farms, etc. So that leads to most likely higher food inflation. And that is something that we need to watch. We know we have US CPI today. It's not going to be a big deal, in my view. Why? Because a consensus is already at 3.4%, up from 2.4%. So that's already a significant increase. If in the numbers we see only oil being the contributor to that, we're good. But if we see core inflation starting to pick up as well, that's where the worry is, because that's what the Fed is looking at. Yesterday we had core PCE. It's usually a data that is not necessarily front and center for viewers and people in general, because CPI is kind of has the headline. But core PCE came harder. We had 2 months, January and February, with about 0.37, 0.39, which leads to the highest pace of increase over 1 year. So directionally, we see core inflation is already not decelerating, and now we're adding another factor, that is oil prices higher, that will lead most likely to higher core inflation as well.
And so what's the big concern? Can we handle like a month of core inflation looking like it might go up, or do we start to worry?
We start to worry.
Because it's been a struggle to try and get inflation down over the last few years, especially for the U.S.
Right. So the target for the Fed and most central bank really is 2%. We're not at 2%, right? We're not at 2% in Canada. Core is at 2.3. We're not at 2% in the U.S. Core PC actually came out around 3%. So that's already a bar that's high compared to what the target is. And the other factor to consider is oil prices today. When you look at, there's something called the strip of forward, like forward prices for oil. They are pricing in that we're going back closely to where we were before the conflict. You may have maybe $5 to $10 premium.
Really? They're starting to price for what month are they starting to price down to $60? Are you talking $60 a barrel?
70. When you look at, let's say, 2027 like projection for oil, market is saying that we're going to go back closer to, let's say, 70, right? But I don't believe so, because we not only have not reopened Hormuz effectively, but we're also going to have to face the physical shortage of oil, meaning how much are you willing to pay for the availability of oil? And I'm sure Asian nations, as we know, the massive oil importer like Taiwan or Philippines, are going to have to bid almost on what is readily available to be able to continue to get supply.
So is that good or bad for Canada and North America, really? I mean, because we're oil exporters. Is this an opportunity, or are we going to we'll feel the effects anyways, no matter what?
I think it's an opportunity for Canada, not only from an oil perspective, but also on a gas perspective. If you think about Europe, so Europe was heavily dependent on Russia, on LNG. And then they switched over to Qatar after the Ukraine war. And now Qatar installation and facilities were being damaged. And they have also come out and say there will be time necessary to rebuild the capability, etc. So Europe is going to have to find another source of LNG, and that could be an opportunity for Canada.
So what kind of a factor then is, I was just seeing a story today from the Ukrainians that there might be talks and the possibility of a peace deal with Russia.
Yes.
Could be closer than further away. What kind of a role does that play then in all this?
It does reshuffle the cards. I think Russia has been one of the winners in this situation, because the sanctioned oil that was seaborne was trading with a premium during the conflict, while it was trading with a discount before the conflict. So that makes incremental revenue for Russia. And if there is some form of a truce between Ukraine and Russia, that's somewhat reduce the pressure on oil prices and also on gas prices globally. So that could offset a little bit, but given the magnitude of the supply that we're missing, 20%, LNG about 15, that's a bar really high in my view to have just the conflict offsetting that.
And we're almost out of it, but they have managed to get the impact down to, I think it's about 11 million barrels. Like, they cut that in half almost. Because they've done a lot of redirecting through Saudi Arabia up north. So that's helping ease it. And could they continue to increase that, do you think?
They do, but I think the demand destruction that can also come, meaning people are going to try to consume less oil. And we can see in countries like Philippines where they're adding a day off during the week, or Pakistan, I can't remember which one it is, but trying to reduce the demand for gasoline so that they can go through the process of this physical shortage of oil. Okay. That can help on the margin, but I don't think it's sufficient, and market is still not necessarily fully pricing in the risk of higher for longer oil prices.
All right, we have to wrap it up there. We've got lots to talk to coming up. Up next, though, we'll take a look at the markets before the bell, see how they're doing. All right, let's see how things are shaping up on the markets. And we'll start with the U.S. futures, and they're pretty much flat right now. I think everybody's waiting for everything right now. We've got inflation numbers coming out in the States, then the weekend talks. between Iran and the U.S. and Pakistan. And so everybody right now is just kind of sitting and holding tight, especially for those inflation numbers. Asian markets, though, bit of a different story. Everybody's in the green there, quite happy with how things are unfolding. It looks like Nikkei up by 1.84 to regain some of the losses again. And Hang Seng 0.55 and CSI 300 up by 1.54 as well. Heading to Europe, same situation, not as strong, but still in the green as they head into the weekend. A lot of recovery around the world the last couple of weeks. FTSE up by 0.32, CAC 0.63, and the DAX up by 0.66. TSX yesterday, the only one in the red yesterday, and ended up today down by 0.42%. And most of the indices were in the red. The big hit came in tech, down by more than 4%. And the positive indices, financials, industrials, healthcare, and they were barely up yesterday. Some of the winners and losers from yesterday, let's have a look here. BlackBerry on their earnings up 7.36%. Acon Group 4.89%. Going the other way, Shopify down 6.5%, and TELUS up by 6.8%. And looking at metals now, and a bit of a mix right now. The gold off by 0.6, down below 4,800, but it has recovered over the last week and is up around 48, but dropping slightly now. And silver also off by 0.73%, but again, it's made some gains after some big losses. And copper is pushing up back toward $6. It's up 2.26%. Taking a look at oil now. Yesterday, Western Canadian Select recovered a little bit after that big dump. It was up 1.5%. And WTI today, what's it do? There we go. Off ever so slightly. Again, much like the markets, I think everybody's waiting to see the next move. It's down by 0.1, below 98 a barrel. Our guest says Canada's economy is showing more strain than the U.S. right now due to weaker growth, softer housing, and a cooling labor market with higher oil prices also feeding into inflation. So today's job report may matter less for the headline and more for what's happening beneath the surface. Let's bring back Hadiza Jatal, VP and Portfolio Manager at Mackenzie Investments. Hadiza, what are you looking for in the numbers today?
I think I'll be looking at full employment as usual. Mm-hmm. We've seen an interesting trend on labor on the labor market in Canada. Fall was fairly strong. We had about 50,000 in November and October on average, and then we had some poor number right after. So January was weak. February was weak. February was very weak.
Yeah.
Minus 84,000 job destruction. So now we're really wanting to see, is this an inflection point where we're going to see further deterioration, or we're going to see somewhat, this is a write-off, those two numbers were weak, but now we're trending back up again. Market consensus is 15,000, which is not great, but it's having
it's in the right direction.
It's in the right direction. It's a small number, but it's tendentially is better. But we know there's also a lot of volatility when we look at labor market data. I like to look at both LFS, which is a consumer-led survey, but also SCPH, which is more on the corporate side because it's tied to payroll. So having those two in conjunction is a good picture of the economy. But I'm still not positive on what's going on in Canada. I think when we think about the two big engines that have been driving growth and allow us to avoid recession despite a very aggressive hiking cycle by the BOC after 2022 was immigration. We had 3% plus immigration 2023, 2024, etc. That engine is completely stalled, we know. We know that in Q4 2025, we actually lost 100,000, so contraction of the population. And I don't see how the new trend is going to be more positive. Immigration is a very powerful economic tool because people come in, they spend, they rent. It's almost instant demand that we have disrupted. So that's one. Second one is real estate. We all know the situation on the real estate market and all the catastrophic number in terms of very low number of sales. We see more power of sale as well. Delinquencies are picking up. So those two drivers have benefited to also Ontario and BC, and those are not going to contribute anymore. And that's, to me, the key worry because I don't see what takes over. The resource discussion we just had could be one, but that takes time, obviously. It takes years to build pipeline between countries to be able to transport gas or any type of energy.
And so that takes some patience. Going back, we were talking about how it's been a slow hire, slow fire.
Mm-hmm.
If we see a dip this month, although again we're talking about 15,000, is that finally companies are now having to make decisions? Or if we see 3 months of dips in jobs, is that companies now facing pressures and then add in the potential with the pressures of inflation from the oil?
Yeah, I would read it that way. And I also would think ahead of the USMCA renegotiation that are coming soon, that is going to also take a toll on business confidence. So if going into that event, we're already seeing weaker job creation, that cannot really get to an improvement going into USMCA, given the uncertainty that is surrounding. And again, certain provinces are going to be impacted more. We know Quebec, obviously Ontario is another one, but definitely this number is key in terms of what the direction we're getting going into weaker economy. As per Bank of Canada, a projection for growth are 1.5. That's very weak in terms of growth, even compared to the US where we're running around 3%. So it's definitely a key number to see if we're at a turning point and how we're getting into USMCA negotiation.
And with the immigration, is this an adjustment that we're seeing, or is this or are we really feeling the impact of not having new people coming in?
We're feeling the impact. Look at the rent market. The main demand for rent is coming from non-permanent resident, international students, and those were the key population that led the population growth back in the year prior to this one. So that definitely is felt on rent for sure, and also in certain sector consumption, etc. is kind of spread across, but that's the overall, I would say, impact.
And looking forward, what should we be looking as we look ahead? What should we be looking for some of these numbers? What will be concerning?
Concerning would be again full employment. If we see full employment really weak, part-time is very volatile, but part-time obviously doesn't necessarily provide a strong support for growth. I will also listen to what company CEOs are saying. If you're hearing more plan for firing, attrition of the workforce, those are actually something that our analysts, credit analysts, McKinsey work on, where they scan kind of the scripts and see if there is firing, reduction of labor force.
All right, we have to take a break right now, but we'll be back. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Mondelez. Let's take a look at some of the notable analyst calls and recommendations. Bank of America raised its price target on Mondelez to 65 from 62, keeping a buy rating on the shares in packaged food and protein. The firm favors Mondelez given positive checks coming out of the firm's March meetings with management and a seemingly positive update on European chocolate retailer negotiations. TD Cowen reducing its price target on Strategy to 350, a 20.5% cut from the prior 440, while holding its buy rating on the largest publicly traded corporate holder of Bitcoin. TD Cowen analysts attributing the revised Strategy price target to a lower Bitcoin price deck and a reduction in the valuation multiple applied to the company's projected Bitcoin gains. Stevens cut its recommendation on Simply Good Foods to equal weight from overweight, citing its significant guidance reduction when the Quest protein bar maker reported earnings on Thursday. Smart, safe, and stylish. That's an eyewear company's bet on the future of the market for smart eyeglasses, globally and in Canada. For more, we sat down with Harrison Groves, CEO of Innovative Eyewear.
Our mission is to upgrade the world's eyewear by adding useful technology features to comfortable prescription-ready glasses. We're the first company in the world to ever ship a prescription-fitted smart glass direct to a consumer back in 2018. And since then, we've introduced a number of innovations to the market to make smart glasses more enjoyable and useful for all-day prescription wear. Our glasses are essentially a Bluetooth headset and specs in one. They pair up to your phone or your smartwatch and act as an audio interface for that device. So you can listen to music, take phone calls, and through our custom integration with ChatGPT, also access the world's information through LLMs.
Okay, so you have your own brand, I understand, but you also are a licensee for other brands like Reebok and Nautica. What's the bigger business currently for you?
Our number one product right now is Lucid Armor Smart Safety Glasses. We've taken an interesting approach where we're using our own Lucid brand that I co-founded back in 2017 as more of our direct-to-consumer e-commerce products, and we're using our licensed products under Reebok, Nautica, and Eddie Bauer through our partnership with Authentic Brands. As more of our retail, brick-and-mortar retail products that are designed more for traditional optical stores and big box stores.
Okay. How big is the market for smart glasses at this point? I know your revenues last year were up by 2/3, but you're still under $3 million. So what's your forecast look like?
Yeah, so smart glasses have been seen as sort of a niche early adopter product by the optical industry and other eyewear retailers until very recently. Only in the last year or two are most optical retailers waking up to the fact that they need to get on board with smart eyewear or they're going to lose that revenue to other sources. So I think the market is growing very rapidly. We're up to about a $2 billion U.S. market in 2025. That's about 3% of the overall U.S. eyewear market, which sits at about $68 billion annual. It's a very large market we're addressing. And if you look at what happened with smartwatches, which is the closest analogy to what our product is, the Apple Watch came out in 2015, which was the first killer product in the smartwatch market. And just 5 years later, the entire global watch market became the smartwatch market. And as of about 2020, over half of all watches sold in the world are smartwatches. And we see that same digital transformation coming for eyewear in the next few years.
So
I put it around 2030.
Harrison, who are your competitors?
So I really see it as what we're trying to do is disrupt the traditional optical market. And we've eliminated all of the costs of switching from traditional eyewear to smart eyewear. And we've made it much easier for consumers to switch to smart eyewear by introducing the necessary style, size, and functionality varieties that are needed by the wider optical market. We're the only US company producing smart eyewear for optical, sun, safety, and sport channels. So I really see our biggest competitor as the legacy eyewear market. Of course, there are a few other smart glasses on the market, but in my opinion, none of them offer the same mix of functionality and all-day prescription wear that we're offering at the price that we're offering it. So I don't really see us as competing directly with them, but really more with traditional eyewear that's at our price point.
Okay, I know your products are made in China. I'm wondering how you've managed or been able to sidestep, if you have, tariffs.
Yeah, so fortunately, there was a carve out early on in the tariffs for electronic devices, and they were brought in at lower tariff rates compared to traditional eyewear, actually, which helped us achieve price parity with traditional eyewear. So smart glasses have always been at a lower, since the new tariffs came in effect early last year, smart glasses have been at a lower tariff rate. And yet we still move very quickly to develop a global fulfillment network and start growing our global business because this was an opportunity to do so at the time. But yeah, I think that, as a result of this sort of carve out, which we think was engineered largely by Apple for electronic devices, we weren't as negatively impacted as companies making traditional eyewear, which faced tariff rates as high as 150% at certain times in the last year and a half. That's calmed down now since to about 30-40%, but smart eyewear is still at a much lower rate, closer to the 10% we were at before the beginning of last year.
All right, so what's your presence like in Canada at this point?
Yeah, so we're growing in Canada. Canada's a little bit behind the U.S. in terms of adoption of emerging technologies, so it's still early days. But we're sold through the largest e-commerce website, e-commerce eyewear website in Canada, which is called kits.com. They've been a partner with us for a little over a year now. And we're also working with a coalition of independent eyewear stores called I Recommend. It's about 600 stores in Canada. And we're working with a couple of, we're starting to work with some of the hardware retailers in Canada on the smart safety glasses as well. I'm expecting a brick and mortar rollout on those later this year in a notable chain of hardware stores in Canada.
That's Harrison Groves, CEO of Innovative Eyewear. Still ahead, Stats Canada is releasing its labor force data for March after the break. All right, Stats Canada has just released the latest Canadian employment report, and it was little changed in March. The employment rate held steady at 60.6%. The unemployment rate unchanged at 6.7%. Across the major age groups, employment held steady, and the unemployment rate was pretty much the same in all those groups. Employment rose in the other services industry, which includes personal and repair services. It also increased in natural resources. Employment declined in finance, insurance, real estate, rental, and leasing. Joining us now for some in-depth analysis is Brendan Bernard, senior economist at Indeed. Brendan, thanks as always for joining us.
Thanks for having me.
All right, looking at the numbers, I think we were saying 15,000. We got 14,000. Any real surprises here?
I think it's just a bit of a relief after that really brutal number that we saw in February. Things are on hold now. And that February number was in the context of a surprisingly strong Q4. And you got to take all of these numbers together. And what they highlight is, I think, a fairly stable labor market over the past year. The 6.7% unemployment rate is pretty close to what it was a year ago. This is not a job seekers market. There's all the challenges that have built up for Canadian workers looking for new jobs, looking to get into the labor market, youth unemployment. These all persist. But momentum-wise, it looks like things held steady. And after a rough February, that's still at least glass half full, not bad news.
Brendan, when you look at the detail sector by sector, do you see any surprises or things that you would have expected to be maybe weaker or stronger? Because when I look at the fall, to your point, was very strong. Fall plus some of the bad number we had January and February approximately leave us to about 12,000 positive. Now we have another 14. So that's 26,000 kind of on cumulative base. How does that make you feel when you look at the different sectors?
Mm-hmm. So these days, the first sector I check for the job numbers is what's going on in manufacturing, just because that is obviously the sector that's most impacted by trade and tariffs and all that. And Canada's the LFS manufacturing numbers were quite weak to start the year. Very little change in March, fitting with the headline number. So in that sense, the kind of the headline and some of the industry detail looks pretty similar. Another, you mentioned other services, which is kind of a grab-all bag of industries driving gains. Also some strength in a few others. Natural resources, that's one where things were strong. And I don't think that's related to the near-term spike in energy prices that's happened. But not, at the same time, this is a sector, especially on the non-energy mining side, where job growth actually has been pretty strong over the past few years. And then we also saw a solid pace of gains in professional, scientific, and technical services. This includes tech, that's the main area of it, but also other white-collar areas of the economy. And this sector was one where it showed huge growth coming out of the pandemic, but has been quite flat over the past few years. Coincidentally or not, amid the new AI era. 1 month definitely doesn't make a trend, but interesting to see strong gains in that area as well.
Totally agree. Maybe one last one from me. How do you feel about the ratio between part-time and full-time?
Let me take a look, actually. In general, these part-time, full-time numbers don't show. They're pretty volatile.
Yeah, absolutely. Yes.
But looking at the month-over-month change, sorry, 1 second. We see that this month was, both were relatively flat. Part-time drove the net increase, but there wasn't much of a net increase to speak of. 15,000 overall isn't very much. And full-time ticked down by about 1,000. Which is a rounding error in these numbers. So overall, the part-time full-time split doesn't influence too much what the overall message of this labor report has been, and also this part-time full-time split quite volatile. We see in some months real divergence that gets reversed in the following ones. So I think, like in general, I prefer to take a longer view looking at those dynamics.
Totally agree. Thank you. It's great.
I want to bring it about average hourly wages. I was just looking at this, up 4.7% year over year, the highest in a year and a half. What kind of a concern is that, or is that a good thing?
You know, so StatCan mentions further down in its write-up, there's some shifts going on in these numbers that are driving that surprising strength. Because you're right, at the start of the year, average hourly earnings were going 3.3%. Now they're verging in. Now they're 4.7%. What's happening over just 2 months? One thing they mention in their write-up, and we've seen this at other points throughout the past few years, is that changes in the types of jobs people are working can drive the overall measure of average hourly wages, even when, for any given job, the pace of wage growth hasn't shifted that much. And so in their write-up, they mentioned that kind of taking into account these shifting mixes of jobs, like, for instance, maybe there were more people who had in the labor force survey that had worked in their job for a long period. And if they got longer wages, well, then that pushes up the average. Holding sort of these composition of factors fixed, average hourly earnings were up 3.6% year over year in March. That's a steadier rate than the 4.7% headline. I think this is also an important number just for the broader context of the labor market. Over the past year or so, Canadian inflation has been chugging pretty close to target, around 2%. And now we're about to enter at least somewhat of a different environment, which we'll first see starting in the March CPI numbers and then the following months, just from rising energy prices around the world. So coming in, let's say we've got in the mid threes in terms of wage growth. Well, that was more than enough to actually outpace inflation entering in this energy situation. Now we've got spiking gas prices. The purchasing power of Canadian workers is going to be under pressure.
Okay, we have to wrap it up there, Brendan, but always a pleasure to talk to you, sir. Thanks for joining us. Have a great weekend.
Thanks for having me.
Brendan Bernard is senior economist at Indeed. Now let's get to the other stories we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump says Iran is doing a, quote, very poor job of handling the Strait of Hormuz, saying it does not follow the agreement in place. Iranian lawmakers claim some ships going through the strait are being charged fees as high as $2 million. Their comments come after this week's ceasefire talks between the two countries, with another round scheduled for Saturday. The owner of Cold Stone Creamery and Mr. Sub posted higher first quarter profit despite missing revenue estimates. MTY Food Group reports that net income was nearly $37 million, up sharply from a year ago. The jump was largely driven by foreign exchange gains. However, the company did miss revenue expectations as it saw a decline in corporate store sales in the U.S. Cascades has lowered its first quarter earnings outlook by more than $10 million. The Quebec-based paper and packaging company says the revision reflects weather disruptions in the U.S., higher transportation and fuel costs, and ongoing geopolitical uncertainty. However, the company says it remains committed to its long-term goal of delivering $100 million in improved profit by the end of 26. Still ahead, today's market drivers with Bloomberg's Janine Panzer. And, of course, our phone lines are open. Adiza Jatawa is taking your questions. Call us at 1-855-326-6266. Email first call at bellmedia.ca. All right, let's take a look at some early market movers. We're joined now by Bloomberg's Janine Panzer. Janine, thanks as always for joining us. And Taiwan Semi, doing all right.
Yes, we're looking at the TSMC, and the March sales reports are actually really good. It's beat analyst expectation, and that's showing strong demands for AI. That's continuing. And the numbers are so important, especially right now. Investors are watching closely because of the war in the Middle East. So far, demand for chips appear to be holding up despite, like I said, concern about higher energy prices and global supply chain disruption. Analysts are saying that the results suggest that continued momentum in advanced 3 and 5 nanometer chips. These are important for AI and supporting growth into the second quarter. But we might not see the increase in capital spending budget target just yet. Management might be a little bit cautious due to the uncertainty, of course, in macroeconomics. But yeah, Bernstein says that AI should continue to drive the business, even as smartphones remain a little bit weak in this area. Adding any slowdown there could actually ship capacity to its AI consumers.
Okay, and Lumentum getting a bit of a push from NVIDIA and leading the way.
Yes. So Lumentum is, of course, NVIDIA backed the got $2 billion investment last month, and yet it is among the leading gains among optical component makers this morning. The company says that orders from major U.S. tech companies that have been getting so much orders that demand now expected to fill its capacity through 2028. The CEO was on Bloomberg TV earlier saying that hyperscalers remain strong, adding the company is struggling to keep up despite actually adding more capacity, especially in Japan, to make sure they can keep up. But yeah, that could effectively sold out for the next several years. So analysts are saying that Lumentum's component business seeing strong near-term growth. This is driven by demand for lasers used in AI data centers with further upside from next-generation optical technologies. And one really interesting thing about Lumentum is that the stock has been standout performers, up about 143% this year.
All right, and I'm looking at Madison Square Garden Sports. Are we going to get a chance to maybe buy the Rangers if we put our money together?
Yeah, we have to see about that. But Madison Square Garden is actually moving higher at the open after Seaport upgraded the stock to buy with a price target of $430. This call centers on potential changes to company structures and taxes. Seaport say that a new tax rule coming in 2027 could increase how much MSG Sports pays on compensation for the top management and players tied to the Knicks and the Rangers. Because of that, the firm sees an incentive analysts say the firm sees an incentive for the company to consider options like spinning off the teams, selling a stake, or even going private. And of course, this comes after in February that we reported that the company is exploring to split the Knicks and the Rangers into two separate publicly traded companies.
All right, let's get our pennies together. Janine, thank you very much for that. Bloomberg's Janine Panzer. After the break, we'll take a look at MP Marilyn Gladu and her decision to join the Liberal caucus. That's ahead. Well, there have been a flurry of questions about Conservative MP Marilyn Gladu and her decision to join the Liberal caucus. She was a staunch Conservative for years with opposing views before suddenly switching allegiance. CTV's Abigail Beeman has more on what both Mark Carney and Pierre Poilievre have to say about this floor crosser and the possibility of more to come.
The Liberals are in for 4 long years.
A Conservative so dyed in the wool she dressed up as Death.
Death is not ready for you.
To pump up her election-defeated colleagues a decade ago. A few years later,
my name is Marilyn Gladu, and I'm running to be the federal leader of the Conservative Party and the next Prime Minister of Canada.
Today's Liberal Prime Minister left explaining how the newly bigger tent Liberal Party absorbs Gladu, a social conservative who fought a bill banning conversion therapy for being too broad and said she'd allow MPs to advance bills restricting abortion.
She will vote with the government if there are votes relating to any aspect of that issue, as well as the rights of Canadians to be their whole selves, to love who they love, and to fully enjoy their rights.
Mark Carney is saying to Canadians, your vote does not count.
In BC, the Conservative leader said constituents should be able to have a by-election after a floor crossing, and he deflected a question about what losing 4 MPs means for his leadership.
87% of grassroots Conservatives who backed up my leadership less than 90 days ago to fight for an affordable, safe, and strong Canada. Our mandate and my leadership does not come from dirty backroom deals.
While the newest federal party leader sees the floor crossings as an opportunity.
They're getting floor crossers from the extreme right, and I don't know what it means to be a liberal anymore. Canadians need a progressive alternative, and the lane is wide open for the NDP there.
Asked about the possibility of even more floor crossers, which has political circles buzzing, the Prime Minister said in this process he's nearly the last to know. Abigail Beeman, CTV News, Ottawa.
When we come back, Hadiza Jattau takes your questions on First Call. Time for First Call and first email, and the honor goes to Sam, who says, are current interest rates restrictive enough to slow the economy, or do you think policy is still not tight enough?
Excellent question. I don't think they're restrictive. I do think that given the starting point of Canada being in a softer space, labor market is not doing better. We just had the number today. It was inconclusive. We need more data, and I'll be looking into the SPEH report published at the end of April. I think it's April 29th or 30th. So we're not in a good place. And unless policy is a bit more accommodative, there is no really impulse that is going to come and support the economy from a monetary perspective. Then the other lever is going to be fiscal. If Carney government is ready to spend more to support household, and I think the gasoline prices that we're already paying significantly higher today are going to also impact household cash flow. So you have almost a worsened situation from a place that is already softer. And to me, the policy rate should be lower. And I know it's not a consensus view. We actually saw after the Iran conflict started, we saw in market pricing, hikes being priced in again for Bank of Canada.
Yeah, possibly two.
Up to four.
Oh,
on
4?
Certain days, intradays,
yeah.
when oil was going at 120, we had 4 hikes at some point price. Now they came down significantly and across all global rates, but you still have this risk where Bank of Canada should technically cut rates to kind of give stimulus to the economy, but cannot really cut rate until they see the real impact of higher not only gas prices, but also all the different subcomponents that we discussed. If you think about food inflation, even the plastic that wraps your food has petrochemicals embedded in it. If you think about just crops, you also need some type of fertilizer and all the components that are coming from oil. So all that effect needs to be clearly identified before the Bank of Canada gets certainty or confidence at least in lowering rates, but I think they should.
Yeah, and somebody said, and just to lower it, just to make people feel better.
Yes.
Like just a psychological effect
of it. They actually did a very good analysis on mortgage renewal when they were showing that for the 2026 renewal, on average, households who are renewing their mortgages see an increase of 6% of the mortgage payment. That's not insignificant.
No, it's a lot.
That's an increase, and you're adding now gasoline prices that are going to be a bigger budget on their budgets. It's complicated.
Okay, let's get a couple more questions in here. This one is from Polly. Is the U.S. dollar still being driven more by rate differentials or by global risk sentiment right now? And do you think the dollar remains overvalued?
So it's also a very good question. The way the dollar traded going into this conflict was very surprising. And the reason why it actually appreciated. So you would think...
people move to it for a safe haven, right?
Yes, but it was exacerbated by the fact that going into the event, the bearish dollar view was the most consensus trade on the street. Everybody was short dollar, long something else, and that reversed, and you added some of that safety. But if you think about it more, if U.S. is going into war, they're going to have to spend more, right? There is that, and markets should discount that so much in the currency, and that was not discounted. From here, I would be a bit more bearish on U.S. dollar for a few reasons. The first one is the petrodollar, right? All these nations in GCC that used to receive U.S. dollars as part of selling oil are now somewhat restraining their ability to sell. And usually, it's not mechanic, but usually they will reinvest into U.S. assets. They will buy U.S. equities, they will buy U.S. treasuries, and that is going to be a driver that is going to be de-emphasized going from here. But I also think it's going to be tied to the fiscal policy that we're into. So overall, I would say bearish U.S. dollar, and market has been looking for ways to collect carry. The carry narrative you would hear often, people buying Brazilian real or buying Mexican peso. Buying Brazilian real assets today, just on the fixed income side, it's giving you 14%. If you have a currency that can deliver 14%, and then maybe even Mexico gives you a bit less, 7%, you're still very much tempted to go towards those currencies rather than going into US dollar, especially because I think this conflict has now passed the peak narrative, the peak escalation. Yes, we're going to see volatility with the renegotiation, but overall, we are somewhat in a better place from a market sentiment perspective, maybe than we were 2 weeks ago, and that will account as part of the bearish U.S. dollar view.
Okay, we have to wrap it up there, but thank you as always for joining us, Hatice. We appreciate it. Have a great weekend. That is it for us on the street. Thanks again to Hatice Jatau for joining us. And then Andy is up next with the Open. Trading gets underway a little more than 30 minutes from now. Have a great day.